In 2014, journalists uncovered thousands of confidential tax rulings that revealed how multinational corporations had negotiated their way out of billions in taxes, and nobody was breaking the law. The conventional story is simple. Corporations dodge taxes through offshore accounts and shell companies. That's true, but it misses the real architecture. The Luxembourg Leaks exposed something far more elegant and legal. Between the 1980s and early 2010s, Luxembourg's tax authority granted advanced tax rulings, private agreements between the government and multinational firms. These rulings allowed companies like Amazon, Apple, and IKEA to negotiate their tax liability in advance, sometimes paying rates near 0%. The system wasn't hidden in the shadows. It was sitting in plain sight, built into the tax code itself. Here's how it worked mechanically. A corporation would approach Luxembourg's tax administration with a proposal. We're considering investing here. What would our tax burden look like under this structure? The government would then issue a ruling, a binding, secret agreement that locked in a favorable rate, often contingent on the company routing profits through Luxembourg subsidiaries. The ruling was confidential. Neither the public nor other countries knew it existed. It was a bilateral contract between a state and a corporation, written in tax code. Why Luxembourg? The country is small, wealthy, and strategically positioned in Europe. Its tax authority was understaffed and underfunded relative to the volume of rulings it issued. Between 2000 and 2010, it approved over 2,000 such rulings. More importantly, Luxembourg's political economy depended on attracting corporate investment. Tax rulings became a competitive tool. Neighboring countries, Ireland, the Netherlands ran similar programs. It was a system feedback loop. Governments competed for corporate tax base by offering secrecy and favorable terms, which eroded the tax base, which forced governments to offer even better deals. But here's where the narrative breaks. The 2014 leak, revealed by investigative journalists and the International Consortium of Investigative Journalists, showed that these rulings were engineered to be opaque. One Amazon ruling, for instance, allowed the company to shift profits to Luxembourg, then back out again, minimizing tax in every jurisdiction. The rulings were legal, yes, but they exploited gaps between national tax codes. A profit earned in Germany could be made to belong to Luxembourg through transfer pricing. The internal prices subsidiaries charge each other. Luxembourg would tax it lightly. Germany wouldn't recapture it. Everyone involved understood the mechanics. The governments weren't victims, they were architects. The real explanation isn't that corporations broke the rules. It's that the rules were designed to be breakable. Tax systems are built on the assumption that income has a clear origin, a place where value was created. But in a globalized economy, value creation is distributed. A tech company's profit might come from intellectual property developed in California, servers hosted in Ireland, and sales in Germany. Which jurisdiction owns it? The tax code had no answer. Corporations and their advisors simply filled that void with the most favorable interpretation. Luxembourg and others codified those interpretations into rulings. The implications ripple outward. Once the leaks became public, pressure mounted. The OECD launched initiatives to align international tax rules. Countries began exchanging information about rulings, but the underlying system persists. Why? Because closing it requires coordinated action across dozens of nations with competing interests. Luxembourg couldn't unilaterally abandon the strategy. It would lose investment. No single country can raise its corporate tax rate without corporations relocating. The feedback loop continues. The leaks changed perception, not structure. What the Luxembourg leaks truly exposed wasn't corruption. It was the predictable outcome of a system where governments compete for capital and corporations have the resources to exploit the gaps. Anyone paying attention to tax policy in the 1990s could see where this led. The architecture was visible. The leak simply made the consequences undeniable. This video is for educational and informational purposes only and is not financial.